In a conference room at HealthSouth Corporation's Birmingham headquarters, senior members of the accounting department gathered for what the record shows they called family meetings. The purpose of these sessions was specific. Real quarterly results had arrived. Wall Street's consensus estimate was known, and the gap between the two had to be closed. On paper, the participants reverse-engineered that gap into fabricated income and distributed it across the company's division ledgers so that no single entry would draw attention. The question this episode answers is not why they did this. It is how a discrepancy that eventually reached approximately $2.7 billion in fabricated earnings could be entered into audited financial statements, quarter after quarter, for roughly 7 years, without the numbers failing to reconcile. The mechanism at the center of HealthSouth was not an exotic derivative or an off-balance sheet vehicle. It was something older and simpler. It was the manipulation of the general ledger itself, specifically through fictitious entries to contra accounts and asset accounts designed to inflate reported income while keeping the balance sheet in apparent equilibrium. Consider what a legitimate accounting system is supposed to do. Every transaction produces a debit and a credit. Revenue is recognized when earned. Expenses are matched against it. The difference is income, and income flows through to retained earnings on the balance sheet. The entire architecture is a closed loop. The income statement and the balance sheet are tied together by double-entry bookkeeping. You cannot simply invent $1 of profit, because that dollar has to appear somewhere as a corresponding asset or a reduction in a liability. If it does not, the books do not balance, and an auditor tracing the entries will find the hole. The HealthSouth fraud was, at its structural core, a sustained effort to solve that problem. The SEC's enforcement complaint, filed in March 2003, alleged that beginning at least as early as 1996, senior officers directed the fabrication of earnings to meet analyst expectations. The fabricated income had to be balanced somewhere, so the manufactured profit was routed into accounts on the asset side of the ledger where it could sit, plausibly, without immediate detection. The problem the accountants faced every quarter was not inventing revenue. Inventing revenue is trivial. The problem was making the offsetting entry survive scrutiny. Understanding how they attempted that is the architecture of the entire case. The process, according to the SEC's filings and the guilty pleas of multiple former HealthSouth financial officers, followed a repeating cycle tied to the quarterly reporting calendar. Step 1. The company closed its books for the quarter and produced actual results. These reflected the genuine operating performance of a large chain of rehabilitation and outpatient surgery facilities. Step 2. Management compared the real number against the consensus earnings per share estimate that analysts covering the stock had published. Where the real results fell short, the shortfall was quantified. This was the figure on the whiteboard. Step 3. The gap was converted into a target for fabricated income. The accounting staff then generated journal entries to close it. On the income statement side, the primary technique was reducing a Contra-Revenue account. HealthSouth booked an allowance called contractual adjustments, an estimate of the difference between what it billed insurers and what it would actually collect. This is a normal account for a healthcare provider. By understating that allowance, the company inflated net revenue without inventing a single fake patient. The estimate was simply bent. Step 4. The offsetting debit had to land on the balance sheet. And here is the structural pressure point. The fabricated income was capitalized. It was moved into accounts for property, plant and equipment, and into cash and other asset lines. The record shows the fictitious entries were frequently booked as additions to fixed assets at individual facilities, which is where the fraud reveals its own logic. A large company operates hundreds of locations. Each holds real equipment. An auditor cannot physically inspect every asset at every site. So the fabricated income was fragmented and distributed across those locations in amounts small enough at each individual facility to fall below the threshold at which the auditor would test the entry. This is the essential design. The SEC alleged that the false entries were deliberately kept under the auditor's scoping threshold. The record describes entries capped below $5,000 per line item at many facilities, on the understanding that the external auditor's sampling methodology would not select transactions of that size for verification. The fraud was engineered to fit inside the known blind spots of the audit process. The result compounded over time. Each quarter's fabrication was not reversed. It accumulated. Fictitious assets built up on the balance sheet, quarter after quarter, until the aggregate gap between reported assets and real assets reached the multi-billion-dollar figure the SEC ultimately identified. The company had, in effect, a phantom layer of property and equipment that existed only as a mathematical counterweight to income that had never been earned. The family meetings were the operational heart of this. Testimony from cooperating former executives established that these sessions were where the target gap was allocated. Multiple former chief financial officers of the company pleaded guilty. In their pleas, the mechanism was described consistently. Management determined the number Wall Street expected, determined the real number, and instructed staff to fill the difference with entries the staff understood to be false. So the question becomes, how did this survive external audit for years? The detection failure at HealthSouth is a study in the limits of sampling-based auditing against an adversary who knows how sampling works. An external audit does not verify every transaction. It cannot. It relies on materiality thresholds and statistical sampling. The auditor sets a scope, selects a sample of transactions above a certain size, tests them, and extrapolates. This methodology is sound against error. It is far weaker against fraud that is specifically structured to evade it. The HealthSouth entries, according to the SEC, were sized and distributed precisely so that they would not be selected. The fraud did not defeat the audit. It fit through it. There is a second structural failure. The fabricated income was concentrated in the contractual adjustment allowance, an estimate. Estimates are, by their nature, the softest part of any financial statement. An auditor testing a hard receivable can confirm it with the debtor. An auditor testing an estimate is testing management's judgment. When management systematically biased that judgment in one direction, the audit had no external anchor to check it against. The record shows the manipulation was routed deliberately toward the accounts that offered auditors the least verifiable ground. Third, there was the question of internal controls and the flow of information. The people generating the entries were the same people responsible for the reconciliations that would have caught them. When the group producing the fraud also controls the checks on the fraud, the segregation of duties that internal control depends on collapses. There was no independent reconciliation because the reconcilers were participants. For earlier detection to have occurred, one of two things would have had to be true. Either the external auditors would have needed to abandon threshold-based sampling in favor of testing the aggregate reasonableness of the fixed asset base against the operating reality of the facilities, comparing reported property and equipment against what a rehabilitation clinic could plausibly hold. Or someone inside the reconciliation chain would have had to break ranks. In the end, the second is what happened. The unraveling followed a specific sequence. On August 27, 2002, the CEOs and CFOs of large public companies were required, for the first time, to personally certify their financial statements under Section 302 of the Sarbanes-Oxley Act, which had been signed into law that July. This changed the personal legal exposure of the individuals signing. In the same period, the company's reported financial performance began to diverge visibly from operating reality. HealthSouth announced that a change in Medicare reimbursement policy would materially reduce earnings, and the stock fell sharply in a single session. The SEC opened an inquiry into trading around that announcement. The decisive event was internal. William Owens, then the company's chief financial officer, began cooperating with federal investigators. The record establishes that Owens recorded conversations with the company's chief executive. Those recordings were made in 2003 as investigators built the case. Armed with cooperating testimony from inside the accounting group, the government could describe the family meetings not as inference, but as documented practice. On March 19, 2003, the SEC filed its enforcement action, alleging that HealthSouth had overstated earnings by at least $1.4 billion since 1999, a figure that expanded as the investigation continued to approximately $2.7 billion in fabricated income over the full period. The complaint described the mechanism in the terms already laid out: the meeting of analyst expectations through fictitious entries offset against inflated assets. The collapse was immediate once exposed because the fraud's own structure guaranteed it. The phantom assets could not be sold, depreciated honestly, or confirmed. The moment auditors and investigators tested the fixed asset base against physical reality, the multi-billion-dollar gap that had been the counterweight to years of fabricated income stood revealed as empty. Multiple former financial officers pleaded guilty. The company itself, as an entity, later reached a settlement with the SEC and survived in restructured form. What the HealthSouth case establishes is a structural finding about the audit itself. The fraud used no instrument that did not already exist in ordinary accounting. It used the contractual adjustment allowance, an account every healthcare provider maintains. It used fixed asset capitalization, the most routine entry on a balance sheet. Its only innovation was to understand the auditor's method well enough to design entries that would pass through it. The record demonstrates that a sampling-based audit, absent independent reconciliation, and a test of aggregate reasonableness cannot detect fraud that has been engineered to fit beneath its thresholds. The direct regulatory consequence was the certification regime under Sarbanes-Oxley sections 302 and 404. Section 404, requiring management assessment and auditor attestation of internal controls over financial reporting, addresses precisely the failure at the center of HealthSouth. The collapse of segregation of duties when the people producing the numbers also control the checks on them. The mechanism that closed the loop was not a moral one. It was a control that made the individual signature a point of personal legal exposure and required, for the first time, an audit not merely of the numbers, but of the system that produced them.